Let's welcome Mary Holm into the studio. Kia ora, Mary.
Kia ora, Jesse.
Nice to see you. Compliments
you.
of the season.
Thanks very much.
What should we talk about today?
Before we talk about money, I wanted to ask you about Zs and Zs, because I noticed as I was driving in...
You and everyone else on the text machine.
Oh, really?
Yeah.
Well, you were inconsistent. 1 minute you were talking about A to Z, and then the next minute you were talking about NZ something. And what's his name? Who does the panel?
Yes, Wallace.
Wallace. He was doing the same thing the other day. He was doing Z sometimes and Z sometimes.
Yeah. My problem is I probably don't care enough.
Yeah.
Whereas for some people, it's a sign of the Americanization of our culture.
Yep.
Back in the day at RNZ, we used to have a really incredible guy called Hewitt Humphrey.
Oh, yes.
And if you weren't sure which way to go, I could give him a call and he would say, here at RNZ, it's schedule. But I know that it's probably Z, right?
Well, you say RNZ.
RNZ,
usually,
yeah, that's RNZ.
But do some people say RNZ?
No.
No.
But yes, to you and to people who have been really stressed out by me saying Z earlier in the show, I withdraw and apologise.
I think it's an age thing. I really do. I think older people tend to get
really
more anti-American.
on their ears, yeah.
Yes, and my friends get very cross when a wordle word is labour or something spelled L-A-B-O-R. They get cross about that. Yes.
Well, at least I'm not saying aluminum.
Yes.
What are we chatting about today?
Well, get to what we're chatting about, which is last time we talked about mortgages and the official cash rate had dropped down and that fewer people were behind on their mortgages than in the past, and that a lot of people were, instead of taking the drop in their mortgage and paying less, dropping their mortgage rate and paying less, they were continuing to pay the old higher amount in order to get rid of the mortgage faster. And we got quite a flood of responses from people sending in texts and emails, and quite a few of them were questions I couldn't answer. I thought, no, look, go to your lender or go to a mortgage advisor. Mortgage advisors are free to you, and ask these questions of them, because I don't know.
Is an advisor the same as a broker?
Yeah. I think they are. Yeah. They seem to, change their names a little bit sometimes.
But they don't charge you by the hour.
No, they don't. They get their money from the bank whose mortgage you end up getting, which it pays to be aware of that. But generally they know a lot about mortgages. But there were 3 different listeners who asked much the same question, and which was basically whether it's better to pay down your mortgage, pay extra off your mortgage, or invest the money elsewhere. And do you want to read one of them?
Please.
Neil said yes.
Why pay more off a mortgage, Mary, costing 5 or 6% interest when you could invest that money in share funds that return 8 or 9% on average? Over 30 years, you'll be hundreds of thousands of dollars better off.
And then he says, poor advice, Mary.
I wasn't going to say
I thought, well, that sounds fair enough, Neil. And then we had a couple of other people, one of them...
if mortgage rates are low, you're better off investing, or are you better off investing the extra money or putting more in KiwiSaver?
Yes, which was the same question. And another listener called Tama asked much the same question. They Tama and Dylan weren't quite as cross with me as Neil was, but and look, it's a really important point that comes up all the time, and it varies depending on how well the share markets are doing and what mortgage interest rates are. The comparison that everyone wants to make is between the interest they're paying on their mortgage and the return they could get on investing the money somewhere else. And because people don't always, that's not always intuitive, but basically, okay, if you're getting a return on your investment, that's increasing your wealth. But in the same way, if you're getting rid of debt that charges 10%, let's say, then that's as good as an investment that gives you 10% in terms of how well off you are. So that's the basic position, is you want to be comparing how much you're paying on debt of any sort. And that's why paying down a credit card or something is really good, because their interest rates are often 10%, 20%. Right? Yeah. And so having an investment that earns you 20% is fantastic. But when mortgage rates drop in particular, you get more people asking this, and I get the listener questions coming in from listeners and readers of my column. And especially when the rates went below 4%. In 2021 and 2022, the mortgage rates were down below 4%. And so people were really saying, well, look, I can do better than that in the share market. And you have
or even
to
in a term deposit, right?
Well,
no, that wouldn't work, because the term deposits always be, My
term
apologies.
deposit rates were down as well.
Yes.
Yeah, so that didn't quite work. But so it's always going to be, if you're going to make more money elsewhere, it's going to be in shares or something similar, or property.
Yep.
It's not going to be in bank accounts or term deposits. But so that's a really interesting comparison to make. But however, Neil in his message to us was talking about making 8 or 9% in a share fund. And what you've got to look at is the return in the share fund after fees and after tax. And that whacks, an 8% return will be down below 6%. It depends a bit on the fees and on your tax bracket. But it's got to be a comparison because when you pay off your mortgage, there are no complications. If you pay off a 6% mortgage, it's worth 6% to you, whereas share fund investments, etc., you've got to look at them after all the costs are coming in, and so that makes the comparison trickier. And the other thing is that, of course, an investment in a share fund or similar, or just individual shares for that matter, there's going to be quite a lot of volatility. So sometimes, some years, you might make 20%, in an extraordinarily good year. But some years you might make minus 10 or minus 20%. And so, you don't know. So it's a much riskier proposition to say I'm going to put my money into a share fund than it is in paying down the mortgage. Paying down the mortgage is like a risk-free investment, and so it's really good for most people. Now,
how does tax work with share funds? I know it's a complicated question, but you say after fees.
They're PI funds. They're called PI funds, portfolio investment entities. Share funds are, and so they're taxed at a slightly more favourable rate than other income. Highest rate is 28%.
When do you get taxed?
You get the fund pays the tax for you.
Yeah.
Every year into Inland Revenue. I think I don't know whether it's once a year or whether it's more often. Actually, that's an interesting question.
Yeah.
But it gets
even if you're not buying and selling.
That's right. It's got nothing to do with buying and selling. It's to do with their buying and selling. The people that run the fund are buying and selling shares, and that's
right.
Yeah, and so that's decides how the share funds.
So you think that 8 or 9% figure that Neil's mentioning is kind of exclusive of fees and tax? Well,
yes. I mean, and even then, getting a return of 8 or 9% is probably a bit optimistic. I mean, in recent times, they've been higher than that, but they can go negative, and they can go quite low as well as negative. And over the year, 8 or 9 probably over recent decades is fair enough, but then you take off the fees, which can take 1% off, especially if you're in an active fund, and then you take the tax off as well, and it comes down to more like 6-ish or something like that. So then, and if your mortgage is 5%, then you say, well, if I'm going to get about 6 in the share fund. So a legitimate point, and there's no sort of dead right answer on this. As far as, I should just mention here, certainly people, even if they've got a mortgage, should be putting enough into KiwiSaver. They should be in KiwiSaver and putting enough in to get the maximum from the government and maximum from their employer. But if you've got a mortgage, it's not a bad idea to be putting extra savings into paying down the mortgage rather than into KiwiSaver. It's the same comparison.
And you've got to pay off that debt at some stage, don't you?
Yes, you do.
Yeah.
And there's a psychological side to it too, which is that for many people, just getting rid of that debt is a huge plus. And if you pay it down early, you're saving. Neil was saying you can make hundreds of thousands of dollars better off if you're in over 30 years in a share fund, but you can be hundreds of thousands of dollars better off by paying your mortgage off faster. It's extraordinary. If you look on a mortgage calculator and see how much less interest you pay, it's phenomenal over a period like 30 years. So at the moment, it's probably kind of 6 of one, half a dozen of the other, really. And because mortgage rates are fairly low, so it's up to you whether you really want to get rid of that horrible debt or whether you're cool with it and you're kind of willing to take a bit of a risk in the share market.
Yeah, and you think you might get an extra % or two on the share market, and you're willing to put up with the volatility and the lack of guarantee.
Yes. Yeah, although you were mentioning a bit earlier, I think, before I came on, the share market's been doing pretty spectacularly, especially the international markets in recent times, which is all could be a worry. They're not going to keep going at that pace.
But they might.
They might.
Okay, let's do a quick fire question to finish, Mary. Are you allowed to pay a mortgage off faster on a fixed term, asks Melissa.
Yes, that was another question that came in. And so a fixed term mortgage, there's usually a penalty if you pay it off early or pay extra off it. But the penalty varies hugely depending on what's happening to the interest rates in the market at the moment. The banks, if interest rates are now lower than have dropped since you got your mortgage, the bank's not going to want you to pay it off fast because they like having a mortgage that's sitting there that's giving them above current market rates. And so the penalty's high. That's how the penalties are set. If it was the other way around, they would be quite happy for you to pay it off and there might be no penalty at all if you're paying off a low interest mortgage and rates have gone up since then. So always ask your lender what the penalty is. Having said that, most of the banks and lenders will let you increase your payments a little bit. So they might say, it's okay for you to increase your payments by $50 a month on a steady rate. If you commit to paying $50 more a month until the end of the term, we will accept that with no penalty. So it's a case of asking the lender what they will offer you, and it will vary. Just because they offered you a certain deal 5 years ago, it'll change depending on what's happening in the markets. So, but it's quite a good idea to keep some of your mortgage floating because you can always pay extra off that without any penalty. So that's one reason to keep maybe a quarter of your loan on a floating rate. Yeah, otherwise you can just sort of set aside the money in a bank account and pay the extra off when the term ends.
Thank you, Mary.
Yeah, no, thanks, Jessie. And happy Christmas, everybody. I won't see you again until, I think it's early Feb, actually, when we come back again. So.
Have a very Merry Christmas.
Thanks very much. You too,
Nice
Jessie.
to see you.